Here's a number that should get your attention. $23.9 billion in a single quarter. That's not Apple. That's not NVIDIA. That's Micron Technology, a memory chip maker from Boise, Idaho, that just posted a revenue number nearly 3 times what it did a year ago.
And the guidance for next quarter is even bigger, $33.5 billion, with 81% gross margins. For a company that 5 years ago was considered a cyclical commodity business, those are transformative numbers.
Today on Charged Alpha, episode 69, we're diving deep into Micron Technology, ticker MU, the company at the center of the AI memory gold rush. Let's get into it. Micron was founded in 1978 in Boise, Idaho. About 53,000 employees worldwide. They're one of only 3 companies on the planet that can manufacture leading-edge memory chips at commercial scale, the other 2 being Samsung and SK Hynix. That's it. 3 companies making the memory that powers virtually every electronic device on Earth.
And the product lineup breaks into 3 main categories. DRAM, that's about 79% of revenue, the fast, volatile memory that processors need for real-time computation. NAND flash, about 20%, the persistent storage in your phone and SSDs. And then the star of the show right now, HBM, high bandwidth memory, the specialized stacked DRAM that sits right next to AI accelerators.
The revenue segments tell an interesting story. Cloud memory is the biggest unit at 39% of revenue. That's where HBM and data center DRAM live. Mobile and client is 31%. Core data center is 17%. And automotive and embedded rounds it out at 13%.
What's happened is that AI has fundamentally reshaped the demand curve for memory. Every large language model, every GPU training cluster, every inference server needs massive amounts of high bandwidth memory. And Micron's entire 2026 HBM supply is already sold out under fixed-price contracts.
CEO Mehrotra actually said they can only fulfill 50 to 65% of what their key customers are asking for. That's a supply constraint story, not a demand question. Speaking of Sanjay Mehrotra, he's been running Micron since May 2017, so about 9 years now. He's a semiconductor lifer with over 40 years in the industry. He co-founded SanDisk back in 1988 and ran it as CEO until Western Digital acquired it in 2016.
Before SanDisk, he held engineering roles at Intel and Integrated Device Technology. So he's built and scaled memory businesses from the ground up. When he came to Micron, the company was still viewed as a boom-and-bust commodity player.
Under Mehrotra, that narrative has completely changed. He's invested aggressively in HBM, secured $6.4 billion in CHIPS Act funding, driven disciplined capital allocation, and pushed Micron to the highest profitability in its 48-year history. The stock reflects it.
Let's get to the numbers, and they are extraordinary. Micron trades at about $378 a share, market cap of $413 billion. The trailing PE is 17.8. But here's where it gets interesting. The forward PE is just 4.2 times. That's because earnings are accelerating so fast that trailing metrics can't keep up.
A forward PE of 4 for a company growing revenue 86%. That seems almost too cheap.
It does look remarkably inexpensive given the growth trajectory. Revenue trailing 12 months is $58.1 billion, up 86% year over year. EPS came in at $21.18. The price-to-sales ratio is 8.2 times.
What about margins?
This is where the transformation is most visible. Gross margin in Q2 was 74.4%. Operating margin was 67.7%. And the guidance for Q3 is 81% gross margins. For a memory company, those are historically unprecedented. 5 years ago, Micron's gross margin was in the 20% range during the cyclical trough.
That's an incredible swing.
Cash flow is equally impressive. Operating cash flow trailing 12 months at $17.5 billion, free cash flow at $10.3 billion, and the balance sheet has never been stronger. $10.3 billion in cash, $10.1 billion in debt. They just paid down $5.4 billion in debt through a tender offer in early April, reaching the highest net cash position in company history.
And they bumped the dividend 30%.
They did, though at a 0.18% yield, it's still a token amount. The real capital return story is the balance sheet strength and reinvestment capacity. CapEx is going to $25 billion plus for HBM and next-generation fab capacity.
Overall, on the financial health.
Overall, Micron's financial health is strong. Record revenue, expanding margins, massive cash generation, and the strongest balance sheet in its history. The forward PE of 4.2 suggests the market is still pricing in cyclical risk despite the structural AI demand thesis.
Wall Street is overwhelmingly bullish. 37 analysts cover the stock. 31 buys, 6 holds, 0 sells. The average price target is 464, about 23% upside from current levels. The range goes from 400 on the low end all the way up to 700 on the high end.
Citigroup has a buy rating with a 425 target. They see AI memory demand as structural, not cyclical. Phillips Securities has a strong buy at 500, pointing to the HBM4 ramp as a multi-year earnings tailwind. Wolfe Research is at 350 with an outperform rating based on supply tightness and pricing power.
Most recent earnings were March 18th, Q2 fiscal 2026. Revenue came in at $23.9 billion, up 196% year over year. EPS was $12.20, crushing the consensus estimate of $8.60 by 42%.
And the guidance was jaw-dropping. Q3 revenue of $33.5 billion, gross margin around 81%, EPS of $19.15, all would be records by wide margins. They also increased CapEx to $25 billion plus for fiscal 2026.
So let's build the bull case. Number 1, HBM for AI. The total addressable market for HBM is projected to grow from $35 billion in 2025 to $100 billion by 2028. That's 40% compound annual growth. And Micron's entire 2026 supply is already spoken for.
Number 2, the earnings trajectory. If you look at the Q3 guidance, $19.15 in EPS for a single quarter, you're looking at annualized earnings north of $60 a share. At today's price, that's a forward multiple in the single digits for a company with structural demand drivers.
Number 3, the CHIPS Act. $6.4 billion in federal grants to build domestic fab capacity. That's not just about economics. It's about geopolitical positioning. When the U.S. government is subsidizing your expansion, it creates a regulatory moat that Korean and Chinese competitors can't match.
And number 4, HBM4. Micron is ramping HBM4 this quarter with an industry-leading 2048-bit interface and 2.8 terabytes per second of bandwidth. That positions them for the next generation of AI accelerators, coming from NVIDIA, AMD, and the hyperscaler custom silicon programs.
All right, Lana, what's the bear case?
The most fundamental concern is cyclicality. Memory has always been a boom and bust industry. If hyperscaler AI capex slows, and there are legitimate questions about the sustainability of current spending levels, the industry could face a massive inventory glut. We've seen 30 to 50% quarterly price swings in DRAM before. The current pricing environment is extraordinary, but nothing lasts forever.
What about the China angle?
That's the second risk. U.S. export controls on HBM to China limit Micron's addressable market. And Chinese competitor CXMT is catching up in legacy DRAM, though they're still years behind on leading-edge nodes. There's also the risk that China controls critical materials like gallium and germanium that are essential for semiconductor manufacturing.
Any competitive concerns?
There are reports that Micron may have lost initial lead supplier status for NVIDIA's next-generation Vera Rubin platform to SK Hynix. If true, that's significant. Being the first supplier to qualify for a new platform gives you volume and pricing advantages that are hard to recoup. Third concern.
And the capex risk?
That's the fourth. $25 billion in capital expenditure is a massive commitment. If demand softens even modestly, Micron could find itself with overcapacity and margin compression. The memory industry has a long history of building too much capacity during booms and paying for it during downturns.
Let's compare Micron to the competition. SK Hynix is the obvious comp. They're the HBM market leader with about 62% share versus Micron's 21%. But SK Hynix trades at just 16 times earnings, a significant discount to Micron's 17.8 times.
Samsung is even cheaper at 14 times earnings. But that's partly because they're a diversified conglomerate. Memory is just one piece of a much larger business. Samsung's HBM share is about 17% and growing. They're planning a 50% production capacity expansion in 2026.
And then Western Digital at about 17 times earnings. Different business. They're focused on NAND and hard disk drives rather than DRAM and HBM. Less exposure to the AI upside, but also less cyclical risk.
The key takeaway is that all three memory makers are benefiting from the AI cycle, but Micron commands the premium valuation because of its pure-play exposure and U.S. geopolitical positioning. Whether that premium is justified depends entirely on how long the HBM supercycle lasts.
On options, the put-call ratio is 1.25, which is slightly above 1, meaning there are more puts than calls on an open interest basis. That's a modestly cautious reading, which might seem at odds with the bullish analyst consensus.
Implied volatility is in the 65th percentile, which is elevated but normal for semiconductors around earnings season. Call open interest clusters at 400, 450, and 500 strikes for May through September. Put clusters are at 350 and 300.
So options traders are positioning for both significant upside and meaningful downside. That's consistent with a high conviction, high volatility name. On the insider front, there's been more selling than buying, about 8 sales versus 1 purchase in recent months.
The standout transactions were the EVP and Chief Business Officer selling about $10.7 million worth of shares in February, and then one insider purchase of 23,000 shares, about $7.8 million, in January. Most of the selling appears tied to scheduled compensation plans, which is typical for tech executives at all-time high stock prices. The January purchase is actually a positive signal.
Risks and watch points. The big one is cyclicality. Memory has never been a straight-line business. The key metric to watch is DRAM and HBM pricing trends. If average selling prices start declining quarter over quarter, that's the canary in the coal mine.
The other watch point is hyperscaler CapEx commitments. If you start hearing major cloud providers talking about rationalizing AI spending, memory demand could soften faster than people expect. Watch for language changes in the earnings calls from Microsoft, Amazon, Google, and Meta.
On the catalyst side, the Q3 earnings report will be enormous. If Micron delivers on that $33.5 billion revenue guide with 81% margins, it'll be one of the most impressive quarters in semiconductor history.
And HBM4 qualification timelines. If Micron secures key design wins for the next wave of AI accelerators, it validates the multi-year growth thesis beyond the current cycle.
Here's the bottom line on Micron. This company has gone from a cyclical commodity chip maker to an essential infrastructure provider for the AI revolution. Record revenue, record margins, record guidance, and a forward PE of 4 that suggests the market still isn't fully pricing in the magnitude of this transformation.
The risks are real. Memory cycles turn, geopolitics are unpredictable, and $25 billion in CapEx is a big bet. But the financial profile is exceptional. The supply-demand imbalance is structural for now, and the CHIPS Act provides a U.S. manufacturing moat that didn't exist 3 years ago. The key metric to watch: HBM pricing and allocation trends. As long as supply stays tight, the thesis holds.
Sanjay Mehrotra, the CEO of Micron, summed it up on the last earnings call. He said, "We believe that the aggregate industry supply will remain substantially short of demand for the foreseeable future." That's the kind of statement that moves markets.
And at 4 times forward earnings, the market is essentially saying it doesn't believe him. If he's right, the stock has a lot of room to run. If he's wrong, memory investors know what cyclical pain feels like.
That's going to do it for episode 69 of Charged Alpha, the S&P 500 Stock Encyclopedia. If you found this analysis valuable, subscribe wherever you listen so you don't miss the next one. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.